There's a $20 bill in your wallet right now. Or at least you think there is. But if you walked into your bank tomorrow and asked to withdraw everything in your account in cash, there's a very real chance they couldn't give it to you. Not because your money isn't there, but because it never really was. In 2008, Washington Mutual had $188 billion in deposits. When customers started asking for their money back all at once, the bank collapsed in 10 days. The largest bank failure in American history. And here's the thing that should bother you: they were following the rules. Every bank in America operates the exact same way. They just don't talk about it. So how does an industry that doesn't manufacture products, doesn't mine resources, and doesn't build infrastructure generate over $600 billion in profit every year in the United States alone? The answer is simpler and stranger than you think. Let's start with what you believe happens when you deposit money. You hand the bank $1,000. They put it in a vault with your name on it. When you need it back, they return your $1,000. Simple, safe, logical. That's not what happens. Here's what actually happens. You deposit $1,000. The bank is legally required to keep about $100 of it in reserve. The other $900, they lend it out immediately to someone buying a car, or a house, or starting a business. That person now has $900 in their account. You still have $1,000 in your account. The bank just created $900 that didn't exist before. But it gets better. That person with the $900 deposits it in their account. The bank keeps $90 in reserve and lends out $810. Someone else now has $810 in their account. Your original $1,000 just became $2,710 in the banking system. And the cycle continues. Economists call this the money multiplier effect. Your grandmother would call it something else. $1,000 in actual deposits can become $10,000 in the economy. All of it appears on balance sheets. All of it feels real when you check your banking app. But only 10% of it exists. Now here's where banks make their fortune. They pay you maybe 0.5% interest on your savings account. On that $1,000 you deposited, they pay you $5 a year. Then they turn around and lend that money out at 5, 6, 7% interest or more. On a mortgage, they might charge 4%. On a credit card, 19%. On some personal loans, 25% or higher. Do the math. They borrow from you at 0.5% and lend at 5%. That's a 9-to-1 spread on money that mostly doesn't exist. It's the most elegant profit machine ever designed. No factory, no inventory, no raw materials. Just the legal ability to lend money they don't have and charge interest on it. JP Morgan Chase made $49 billion in profit last year. Bank of America made $27 billion. Wells Fargo made $19 billion. Not revenue, profit. They're not getting that from ATM fees. But wait, you're thinking, what if everyone asks for their money at the same time? What if the system breaks? That's the best part. It can't. Because the government won't let it. When banks get in trouble, they don't go bankrupt like a restaurant or a clothing store, they get bailouts. So you have an industry that creates money that doesn't exist, charges interest on it, collects fees at every turn, gambles with complex financial products, and gets bailed out when the bets go wrong. And we call this the backbone of the economy. You're not the customer, you're the product. Your deposits are the raw material. Your debt is the revenue stream. And the profits flow upward while the risk flows down. That $20 bill in your wallet, it's real, you can touch it. But the number on your bank app is just a promise. A very convincing one. One that works right up until the moment it doesn't. And the truly brilliant part, they've convinced you it's the safest place for your money.